Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from CIBC Wood Gundy tells us the equity markets are at the fear-building stage, but are also survivable. Casey researches Marin Katusa has survival advice for petroleum investors. And real estate consultant Ross Kay shows how a real estate advisor can save you a bundle. We talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor for CIBC Wood Gundy in Vancouver. Welcome to This Week in Money, Ross.
Always a pleasure to be back.
The equity markets, what a messy or interesting place this week. Can we make any sense out of it?
Well, I think we can make sense out of it. The question is, will the volatility continue along? I mean, we went for months with volatility just at extremely low levels. And, you know, like anything in the marketplace, it's a pendulum. You swing from one side to the other. And to have spent so much time with such low liquidity, people became very complacent. And then when you finally do have a correction, people they're not accustomed to it. And this is what we've seen this week. Is nothing new. We used to see this very commonly. You'd see it, I think, over the last 20 or 30 years. Typically, you'd see this type of price action that we've seen in the last few weeks. Maybe, once every year, or maybe, twice a year, you'd see that type of pullback. But when you've gone a fair amount of time without it, it does catch people off guard. And we had been talking about a number of things. The internals were not looking terribly good at the end of the summer. We had the Hindenburg with the bad new high, new low statistics 3 weeks ago. And then when the dollar stopped that meteoric rise that it had back on October the 6th, that just became, I think, the catalyst for the big cap names, which have been holding up, to finally start giving up ground. Now, in the normal midterm election year, what we're in here this year, there's a real sweet spot in terms of looking to be a buyer. And that comes typically second half of October through until the middle of December. The standard seasonal is that you buy around the 27th or 28th of October and hold out until May. But we like to take the analysis and go one step deeper on it. I look for the characteristics of years when you're in uptrends, typically going into mid-October, and you have a mild correction. And then you look at years where you were actually in a downtrend in the first part of October and starting to make a significant break. And the conclusion that we've got here at this point is that because this is the first sell-off into this seasonal period, not the second. Quite often you'll get sell-offs from July through September. You'll get a bounce and then a retest in October. And from that October move, testing the support, that's the point where you get the nice vertical move into the spring. And, the bank credit analyst looks at all the midterm election years going back to 1950. And from the election day in the States, early November, the market's up an average of 16% into May. So it's a pretty good window for upside action. But as I said, this is the first sell-off that we've had of any significance in the last few months. And it's been down 10% or more in most of the broad indices, which is good. But what you would typically see is a retest of the low. And so, what we're hoping here is that you get a nice bounce off of this oversold condition that we had midweek this week. And it was really oversold. I think we've got something like 85 indicators, and I think better than half of them were at levels, at extremes that you only see at significant major bottoms. So we're at the point where I would call it the fear-building phase. The market's down more than 8%. People are starting to get anxious. And so if we can get past this phase into the next one with a test of the low, and a lot of people becoming even more anxious at that point, if we can hold and turn, really looking for a good 6-month stretch ahead of us.
Well, that's a lot better than what many other people have suggested, saying this is just the start of the slippery slope and hold on.
Well, there's a lot of fear out there. There are the perma bears who have been bearish for extended periods on the way up. Then there are, and clearly they are seeing evidence here that they would say has definitely sort of broken. This is the tip of the iceberg in that the market could have deeper correction. From a valuation point of view, from what I read in here, the larger cap names, the financials, the PE ratios on those, the numbers are not looking terribly bad. I just don't see a big bear market right around the corner.
What gives you the optimism?
I guess the overall trend. I look at the phase that we've been in for this last half a dozen years, since the '08 low and the corrective processes along the way. I see some of this in some of the previous good bull markets, the 1950s, the 1920s. And as long as this corrective phase isn't too bad, I think that you've got a chance for reasonable growth.
Which areas would you avoid?
I would avoid companies that are not making profits. The key here is look for good companies, got solid balance sheets, that are paying a dividend. I like to get paid to wait. If the market wants to thrash around for many months or just hesitate, I want to own something that's going to be paying me 4 or 5%. And right now, with this correction we've had in the market, you're starting to see some very, very attractive numbers again. So that's for individual stocks or some of the fund companies have got some great track records on good dividend paying portfolios. For me, as long as we don't see a real violation, I'm looking at it on a big technical picture, but as long as we don't take out the 2007 highs on a significant correction, then I think we're still talking bull market that's got longevity to it.
Ross is an investment advisor at CIBC Wood Gundy. Ross, how can people get in touch with you?
My email address is ross.clark@cibc.ca, and you can contact me by phone in Vancouver at 604-661-7759.
Ross, you'll be back in 7 days. Thanks a lot for being here.
Thank you.
Coming up, Casey Research's Marin Katusa on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Marin Katusa from CaseyResearch.com. Welcome to This Week in Money, Marin.
My pleasure.
Everybody's noticed the rapid drop in the price of gasoline. Of course, it happened after Canadian Thanksgiving. What a curious thing, because the price of oil has been coming down for some months now. But first of all, what is the cause of this big sudden drop?
A few catalysts. First of all, it's no secret that, we've been writing for months now that the global economy is slowing. But really it was the move by Saudi Arabia, OPEC's largest producer. They basically hit the bid and started selling oil at a discount to the Brent price. That was to have a few multiple effects. First off, it was to lock up market share. It was to create more of an alliance with China, who's now the number one buyer of Saudi Arabian oil, not America. China is. It used to be the U.S. Another thing was to curb back ISIS. Saudi Arabia has a Frankenstein on its hands where, they originally funded ISIS, and ISIS now has turned into a monster of its own, and ISIS has been taking over Syrian and Iraqi oil wells and selling into the black market into Turkey. Also, to prove a point to Russia, where Russia stood by its ally Assad during the Syrian civil war, and the knock in oil prices is hurting Russia, but it's not going to kill Russia. And most importantly, Saudi Arabia has seen the U.S. be its largest buyer, and now because of the success of the shale sector, the quantitative easing, the easy money, the cheap money has fueled the innovation or the shale revolution. And a huge percentage of the jobs created in the U.S. are specifically in the shale areas like Texas, for example, which is the number one job growth in all of the U.S. And that price will start hurting more of the higher cost shale producers. So it's had a multiple effects here, but really the main catalyst was the move of Saudi Arabia to hit the bid.
And I saw the other day, OPEC offered to lock up the price of oil at $80 a barrel long term.
The problem, as we've been writing for over a decade now, the problem with OPEC is when they start having price squabbles, the price actually decreases, and it's because they start cheating. Their quotas are just that. It's a budget, it's a quota. And what they start doing is, doing the two-face, the Cincinnati shuffle, as they call it in the oil patch, where you say you're producing so much and selling at a price, but you're having, off-market transactions. And that's the next thing expected, especially with next week. China's going to be announcing their GDP numbers, and it's no secret in the markets that that's going to, disappoint. The market wants some growth out of China, but it's not growing at the rate that everyone wants it to. That's going to spook the markets. And then November 27th, OPEC has its meeting. So there's a lot of catalysts to be bearish in the near term here on the price of oil.
And after the meeting or the release of the figures next week, where do we go from here?
Well, I think you're going to see the year end to be a bit shaky for oil. You see analysts starting to revise their price decks. Where they used to use $90 oil, they're now saying, okay, we're going to use $82 oil. With that, the impacts on the cash flows of the companies, and we're also entering tax loss season. So from an equity standpoint, like the companies, the stocks, you're going to see, I think personally, you're going to see a lot of selling pressure. Now, on Monday on Thanksgiving, it was essentially a heavy day of selling. Tuesday in Canada was ugly. Wednesday and today, Thursday, was pretty strong buying support. So the question is, the bears and bulls are fighting right now, but the general reality is that the U.S. dollar is strong, and the one saving grace for the Canadian producers is the fact that the Canadian dollar is weak to the U.S. dollar, so that will help the decrease in the price of oil. But essentially, I think we're going to see lower prices here in the near term. But in the long run, nothing's changed. The fundamentals are there.
Marin, I know you told me a short while ago when I asked about high gasoline prices, you said it really doesn't make sense because the world is awash in oil right now. And here we are. Is North America really in the middle of an oil glut?
You see, right now, because of the infrastructure, and I've been talking about this for a long time about how the shale game has changed. For example, if you go to the East Coast in the U.S., in my opinion, the best shale formation, gas shale formation in all of North America is probably the Marcellus shale. What a lot of people don't realize is for about the last year, the Marcellus shale has been selling gas, natural gas, $2 less than the Henry spot price, which has averaged around $4 this year. So in the East Coast in the U.S., the Marcellus has been selling around $2. So that is significant. That's telling you that they can make money with the liquids and natural gas at $2. If you look at in the north here in Canada, everyone's talking about the potential of LNG. Well, we're really behind the eight ball. I've said for a long time that, Canada's infrastructure is lacking, and we're behind the eight ball, not just to the U.S., but Australia, but the rest of the world, including Russia and Qatar. So we need to build our pipelines to the west, to the east, and to the south. It will happen, but it's going to take a lot more money, and it's going to take a lot more time than the Canadian markets want it to. So right now, yes, we are in a wash of oil and natural gas.
Is there any way to speed up those pipelines? I mean, if the price comes down, there's less incentive to do it.
Well, exactly. And remember that the rest of the world doesn't follow the Canadian political regime pace of molasses. If you compare imagine how slow everything moves with our politicians. Well, in Russia, they're not moving at, our pace. They're moving forward big time. They're signing a $40 billion deal with the Russians, with the Chinese, moving their...
Isn't that the world's biggest construction project, the pipeline between Russia and China?
Yes. When it's all said and done, that will be the world's largest ever construction pipeline ever done. Construction project, period. Now think about when you compare that to the canals and the Hoover Dam and all that. This is a massive undertaking. It's going to be a $400 billion deal for the first 20 years. You know that they're going to double up that supply. So all said and done, no, I don't see anything speeding up the process in Canada. And sadly, the gas prices are going to slow it down even more. You saw that the Asians are saying, hey, you guys got to get your act together, that being the politicians and the government. And the politicians don't want to put their necks out. So it's almost like a game of hot potato. Nothing's going to happen until the music stops.
And who's playing that music and who's dancing to the tune?
Well, right now it's the international markets. Russia's moving forward. Australia's moving forward with their LNG infrastructure. You got FLNG, which we've written about for years, the floating LNG, where the largest ships in the world are going to what are stranded, proven gas deposits. They'll be able to produce for less than a dollar per MCF. And, if they don't like the government regime, they pull anchor and go somewhere else where they're welcome. You look at Papua New Guinea's building a major LNG plant. Qatar is increasing their infrastructure. Even the Middle East, they're talking, Israel is looking at becoming a major exporter of LNG. So the reality is the music is being played by the international markets, and the Canadian markets are losing.
Now, we know fracking has been a big factor. How big a factor in oil and gas production?
Massive. It's been the largest factor. If you look at the growth of oil production around the world in the last 5 years, over 85% of that growth is because of the success of the North American shale sector. It's all been because of horizontal fracking. So when you look at the impact horizontal drilling has done in the sector, it is the largest factor. And it's going to continue to be. Now, look, there's areas in North America that you can make a decent return on your investment at $60. But, all of this is an impact of the quantitative easing of people chasing yield, cheap money out there. So the question will be is, how will the U.S. job sector and the energy sector cope with a lower oil price? And I think the pace will slow down in the near term, especially if you see oil drop to $70 a barrel. There's a lot of oil in the world that can be produced for $70 a barrel, including Russia, Saudi Arabia, Kuwait, UAE, there's even in the U.S. So $70, we've talked about now for 2 years in our newsletter, do not buy an oil company if you can't make a decent return at $70 to $75 oil. Well, we're pretty close to there. So you got to be very careful for your portfolio.
What kind of an effect is this having on places like Alberta and Kelowna?
Well, right now in the oil patch, a lot of the companies have hedged themselves. So, for example, take a good company like Whitecap or Crescent Point, who have excellent management teams. They're about half of their production is hedged, and they're hedged at over $90 a barrel of oil. Where you'll see the impact is if this continues to get worse, that is the spot price of oil, and if the Canadian differentials increase, and especially if the Canadian dollar gets stronger, it'll have a huge impact on Calgary, the oil patch in Alberta. And, let's face it, the Kelowna real estate has benefited from the boom in Calgary, where a lot of oil money has come into the vacationing properties. So, look, it's going to affect all of Canada, including the revenues from the oil patch. So, you see that our dollar now is buying less of the American dollars, and that's all an impact because Canada is a resource nation. And where oil goes, Canada goes.
Is there any benefit with lower prices besides, average person just saying, wow, my gas bill is $40 a week less?
Well, there is. If you look at the infrastructure, if you invest in the right management teams that are the lowest cost quartile production cost, it's not going to come to a halt. We saw in 2008 and 2009 oil go from $130 to $30. And, the city didn't shut down. It wasn't as bad as when, Trudeau brought in the National Energy Program. So, yes, it's going to hurt, but there's still great potential. You look at what some of these Canadian companies are doing in the Montney, where they're drilling more wells per section than they were a few years ago. If you look at creating a larger, doing more from a well pad, they're doing more wells and more multi-stage fracs. They're going to be doing thicker wells. They're going to be doing zipper fracs. The technology is improving, and the efficiency is going to increase. So you want to be invested in the best of the breed, and you'll do okay. Now, if you're a trader, staring at the markets, what oil's doing every 5 minutes, you're going to drive yourself crazy. Keep it simple. We know that oil is a finite resource, and the Canadian producers are some of the best producers in the world, and stick with the right management teams, and you'll do okay.
Good advice. Keep it simple. What about the natural gas market? Where's that going right now? Or is that very dependent on what kind of weather we have over the winter?
Completely. If we do not have a cold winter, you will see the supplies increase and the price crash. At what point, will we see that? Well, I have no idea. I don't know what the weather's going to do, and I don't invest based off of, spot prices. You always take a discount to the spot and, value your companies at $2.50 gas and see how they do. Now, I'm not saying gas is going to get there, but the reality is if you can stress test your company using $60 oil and $2.50 gas, and you're happy with their payout ratios, recycle ratios, their expenditures, and their cash flows, hey, you're in the right company. If it starts looking scary at that price, remember it was only 2.5 years ago where gas, the AECO price was below $2 on MCF. So anything can happen. Expect the unexpected.
I know Environment Canada won't be happy with me, but the Farmer's Almanac seems to be pretty good at predicting what kind of winter weather we're going to have.
It's been fantastic.
What's happening with uranium? Is that going to be a hotter product, so to speak?
Well, the interesting item about uranium is the big utilities. 1 in every 5 homes in the U.S. are powered by nuclear energy. It's not going away. There's no competition to uranium. When you look at natural gas and thermal coal, they're competing if you really think about it. And part of the problem with the coal, shale gas killed it. Well, shale gas is not going to kill nuclear, even though a lot of anti-nuke people are saying that it will. It just won't, because the infrastructure costs that have gone in are in the trillions of dollars to replace that. And, the interesting item that I see is 1 in every 10 homes in America is powered by Russian nuclear fuel or sources in the former USSR. And I think that everybody is not paying attention to a potential black swan, which is Kazakhstan. 40% of all the world's production of uranium happens in the former Soviet Republic, which is now Kazakhstan. They've had one leader for 40 years. If there's a revolution there after he dies and, he's not doing well, what happens to the price of uranium? You know that when there's a revolution, it's never good to production. 40% of Kazakhstan are Russian-speaking Russian citizens. You know that, with all of these sanctions against Russia, yet the Americans have no problem buying their uranium, which powers the U.S. nuclear reactors. So it's kind of a conundrum sitting there, and the reality is you want to be a contrarian, and when domestic production cannot make money at current spot prices, it makes you think that maybe we're at the low in uranium. And if you think that the U.S. in 1960 was the largest producer of uranium in the world, over 40 million pounds, and today they produce less than 4.5 million pounds a year and import 90% of what they consume, and you know that China's catching up and even Saudi Arabia is building nuclear reactors, it's a pretty good place to be. So I think that, in the 3 to 5 year span, uranium and nuclear is going to do fantastic.
Places you would recommend long-term investment?
Well, you want to stick with, I would avoid early stage. Depends on your stage of who you are as an investor. Like Cameco is the largest, publicly traded company for uranium. That's a good place to start. Uranium Energy Corp is permitted. They built their plants in the U.S. I really like something called what I coined as WISER uranium, warm ISR production. especially if it's built, it's permitted, it's financed, they've done everything. They're just waiting for better uranium prices. So I would start with those two. I like having exposure to North America. You want to you want to be invested in things that, you take Texas, for example. They are buying whatever they can get from the mines in Texas, the nuclear reactors. So the Uranium Energy Corps in the U.S., there's a market right there for all the uranium they can produce. Same as Cameco. The problem is Cameco has very high-risk production. What I call Cigar Lake is a very risky mine. No one knows if it's going to flood again. This thing's been delayed. It's been twice the budget to produce. But it's a great company, and I would start with those two companies.
What about the future of coal?
It's interesting. In 2011, I was on BNN, and I said, stay away from coal, and you'll see Teck drop at least 50% from where it's trading. At the time, I was laughed at on TV. This is all on BNN. You can go onto their historical files there. And at the time, Teck was trading at $54, and I said, shale's going to kill coal, and, the global economy slowing down, and met coal is going to get hurt just as bad as thermal. People don't realize that thermal coal today is cheaper than it was at the bottom of the 2008 crisis. Shale's the difference. Shale wasn't as impactful in 2008, 2009 as it is today.
And of course, the Chinese government wants to cut its air pollution, so it's putting a duty on coal.
Correct. I wrote an article called The Air Apocalypse, and the reality is the air is awful, whether you go to Hong Kong or Beijing. I was there when was I there? In April. Spent a couple of weeks traveling throughout Asia, and it's awful. You just don't feel good when you're there. They have twice the asthma rate of anywhere else in the world. So changes are happening. Met coal, Teck, there's no secret. If you want exposure to met coal, Teck is the world's best met coal producer. It's the king of coal, and I call it, for met coal. But thermal coal's got a tough go, and if you're going to play it, you want to be in the lowest cost producers. You look at the Powder River Basin, they can produce cheaper than anyone else in the world when it comes to thermal coal. But the reality is I'd stay away from any early stage coal explorers. There's no demand for their product, and coal's all about infrastructure. It's really just moving dirt. You have to have your rail there, your wash plants, and if you don't have your infrastructure, access to rail, it's going to be a tough go.
Marin, can you tell us about your newsletter and how people can subscribe?
Sure. If you go to the Casey Research website, and every Tuesday I have my daily dispatch where I write about my thoughts. It's all free, and if you like, you can sign it out. And then also my first book is in bookstores across North America on November 10th.
And what's it called?
The Colder War. It's based off of my traveling of over 100 countries over the last 12 years, and really what's going on in the energy markets, where we've been, where we are, and where we're going, and how to protect your portfolio.
Thank you very much for being with us.
My pleasure.
My guest has been Marin Katusa from CaseyResearch.com. Thanks again for being on the show. After the break, realty consultant Ross Kay on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ross Kay of Ross Kay Realty Consultants. Ross, welcome to This Week in Money.
And thanks for having me back.
One of the first questions we have here is the real estate sales chain. What is it and how does it work?
A real estate sales chain, generally speaking, applies to the resale market. So in Canada today, people often refer to the housing market. Well, there is no such thing as a singular market being the housing market. The housing market is composed of three different sub-markets. The first is the new home sales market, which you'll get that information from the CMHC. They're probably the best authority for new home information. Then you have resale housing information, the resale market, and then you have the rental market. And each three of those markets operates in a distinctly unique way. For some reason, this really has never been explained to Canadians. And I've gone back to textbooks at post-secondary level for economists, and the markets are never broken down this way. So maybe that's why the sales chain is something that's never been discussed. On a local level, if you know of a realtor who's been in the business a very long time, let's say in excess of 20 years, or another realtor who's sold, let's say they've sold over 500 homes. If you were to ask that realtor how the current home is able to be sold, inevitably they're going to say, well, it's because another house sold. So let's use this example. I own an $800,000 house. In order for someone to buy my $800,000 house, obviously they don't have $800,000 in cash, and they're not going to go out and get an $800,000 mortgage normally. What they're going to do is they're going to be living in a $600,000 home. So in order for them to buy the $800,000 home, they have to sell their $600,000 home. So the sales chain is started. Again, we look at the $600,000 home. In order for them to a buyer to buy that $600,000 home, generally speaking, you're going to see a $400,000 home sell. So the sales chain goes from the lowest price sale, the $400,000, to the $600,000, to the $800,000. And let's assume that $800,000 is going to move. They're going to move up between $1 million and $1.2 million. And then that buyer, if they're going to stay in the housing market, luxury buyers sometimes leave the market and just rent, those people will move to a $1.5 million home. All of those sales can only take place if that first sale happens. If that first sale never happens, those other sales similarly never occur. And that's what's called the sales chain. The sales chain has always been in existence. It is unbreakable. It is not debatable. On the resale market, that's exactly how it operates. Now, people ask, they say, Ross, well, what about first-time buyers? Well, first-time buyers, generally speaking, are always going to be buying your lowest price homes. And as they're buying those homes, there's people at the top end of the market that are leaving. Now, if there's a new home builder in your community and he's building homes, then obviously there's room for new first-time buyers to buy into the market without anybody leaving the market at the other end. And as baby boomers have moved through their buying process, through their buying cycle themselves, the Canadian housing stock has continued to grow. So instead of having 100,000 homes in a city, now there's 110,000 homes in the city, and that's allowed 10,000 new buyers to enter the market while everybody moved up to a more expensive home. So that's what the sales chain. The sales chain is for the resale market, which is a unique market, and the sales chain is unbreakable. It has never changed. What I was not aware of is that the knowledge about the sales chain, which a local realtor could use, has never been extrapolated in a national number. So the reason it's never been, or the causal effect of it never being extrapolated, is that's the reason why the predictions by the Canadian Real Estate Association or CMHC or your local real estate board are always wrong. If you check the press releases from the Canadian Real Estate Association, you'll see that they always revise a previous quarterly release. If you check CMHC's Housing Observer, the quarterly publication by the government, CMHC, about the housing market, they always revise their previous release. Well, the reason they're revising is because they're not taking into account the sales chain, because they have no way of measuring it. A local realtor, like myself, I sold in Burlington, Ontario. Over the first 10 years in the business, I learned about the sales chain. I learned about it from my father, and he learned about it from my great-uncle. And by my knowledge of the sales chain, I could watch the sales that were taking place today, and I knew where the sales tomorrow were going to occur. So if I saw a whole bunch of sales taking place at the $400,000 range, I knew that those people were selling their homes, and now they were going to go out and buy a home. So I knew they would be looking for $600,000 homes. So as a smart realtor, I would go out and solicit listings in the $600,000 range because I know that they would be the hottest commodity in the market. If you extrapolate that information from a local level into a national level, and you find some way of measuring that accurately, it is 100% accurate. We have been working on that for 18 months, At certain times, we didn't think that it was going to be possible. And then we had a breakthrough last month. And I can say today that we can forward predict the real estate market in Canada with 100% accuracy since 1982 till today. So any single month sales from 1982 forward, we can predict whether those sales will be on the decline or on the incline. And over the course of any given period of time, our number will be 100% accurate. It has been so accurate that when we look back at the statistics from the number of homes that have sold in Canada from 1982 forward, there have been 11.5 million resale homes that have been sold through organized real estate. Our demand index is what we're calling it, because it measures how many people are in the system that are going to buy a house. It has, over those 11.5 million homes, there are only 60,000 sales that are unaccounted for. And those 60,000 sales are still out there right now. Those are the people who are waiting to buy a home right now because they've already sold their own home. So we know in Canada today, based on the way that our numbers are calculated, there is only a 45-day supply of buyers who are ready, willing, and able to purchase a home in Canada. We also know by recording that 3 months ago in June, the real estate market in Canada turned. It had turned in most markets across Canada long ago, but we've had the holdouts of Vancouver, Calgary, Fraser Valley, and the Greater Toronto District. And the Greater Toronto District actually is larger than that. It's the entire, what's commonly called the Golden Horseshoe of Ontario, which runs basically from Oshawa all the way around the tip of Lake Ontario to Niagara Falls. That's what the Golden Horseshoe is. That entire market, up until June, had remained on an upward trend. When the numbers came out for June, we noticed that the numbers had declined. So in Vancouver, in Calgary, and in Toronto, the Greater Toronto Area, I could also extend it to the Golden Horseshoe, all of those markets were trending upwards in the number of sales they were going to report each month, and now they're trending downwards. Now, whether or not the downward numbers are being reported, someone can take, a listener can go to the local real estate boards and check. But what I can tell you is, with 100% accuracy, within 3 months of that call, sales will be going down. So the last remaining market, ironically, was out your way, and it was the Fraser Valley market. And it didn't turn till July. So while you may see the sales start to register lower in, they already are registering lower in Vancouver and Calgary. If you look at let's use Calgary for an example, I think the August numbers, they were 11% ahead of last year. September's numbers, they were only 3% ahead of last year. So obviously the market is slowing. This is what the sales chain has always predicted. It's 100% accurate. There's no commas, no asterisks, no disclosures. It is 100% accurate.
More with Ross Kay of Ross Kay Realty Consultants next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with Ross Kay of Ross Kay Realty Consultants. Ross, you were saying that your demand index is 100% accurate into 3 months. 3 months from now, where will we be sitting?
Well, what we know right now is that we're trending at about, up until September, you were trending at about 172,000 homes that should have been reported by year's end. We also know that the market turned in June on a downward slide. So that prediction will be lower. We predict each month out where the number's actually going to be. So in terms of where you're looking, And we can tell you that there's going to be fewer than 470,000 units sell in 2014. So any investor out there who's thinking about buying bank stocks, they should be considering what's going to happen long term if the banks all of a sudden are booking $70 to $80 or $100,000 fewer mortgages next month. What is that going to do to your bank stocks? That's the power of the demand index. That's the power when the consumer has the truth. Are you going to be buying a house right now if you know that there's going to be fewer sales taking place 6 months from now? I know everybody's afraid of that information getting out to the public, but isn't it fair that the public is told the truth and then they're allowed to make their own decision?
Can a buyer and seller benefit from using a real estate advisor in conjunction with a realtor if you have this kind of information in hand?
Right now, in many ways, the consumer is hurt if they're to use a realtor because of the limitations that the realtor has that an advisor does not have. Now, let me explain. An advisor is not licensed by the provincial government to trade in real estate. In other words, an advisor is like a consultant. An advisor sits back and they advise you on what you should be doing buying and selling a house. They advise you on how your house should be marketed. They advise you how you should purchase your home. They give you the information that you need to make an informed decision. The only thing that an advisor can't do is they can't hand your offer over to a homeowner. They can't hand your listing into an MLS association. But other than that, an advisor can do many things that a realtor can't. The consumer is not being protected by the rules that govern realtors. There is nothing in your provincial legislation that 100% protects the consumer. With a realty advisor, there is. Someone cannot be a realty advisor, with our firm anyways, unless they pass a criminal check that includes offenses for assault and sexual offenses. Realtors in most provinces are not bonded. Realty advisors are required to be bonded.
So if a real estate advisor can't do the actual sale, do you hire a real estate agent on the advice of the real estate advisor?
Excellent question. So for the things that you require a realtor for, which are handing over the offer, the realty advisor will hire a realtor to do that. Instead of you paying $15,000, $20,000 in commission, you pay the realty advisor $6,500. Now, let me explain to you what that means. A realty advisor will pay a realtor between $1,000 and $2,000 to hand over an offer because that's what's required by law. For that $2,000, the realty advisor gets errors and omissions insurance, and that realtor is subject to provincial legislation. If that realtor does anything wrong for their clients, the realty advisor makes an immediate phone call to the provincial legislator, and the provincial legislator then charges the realtor. A consumer is not aware of that procedure and how it should work. Your realty advisor does. When you're purchasing a home with a realty advisor, generally speaking, there's commission on the property that's paid to the realtor who's working for you as the buyer. So for the sake of the argument, let's say it's $15,000 that the realtor would earn by selling you a house. With a realty advisor, that $15,000 comes off of the sale price. You only pay your upfront fee to the realty advisor, and you pay nothing else. Now, what the great thing about a realty advisor is that part of the package they're able to offer you is you can purchase any resale home, and that home will have a 1-year warranty, the same that a brand new home would have. That home will have all of your appliance warranted for a full year. That home will have your heating system, your air conditioning system, your plumbing system warranted for a full year. So someone can buy a house using a realty advisor, and for the first time in the history of Canada, they can buy a house that has the same warranty that a brand new home would have.
Thanks a lot, Ross, for being on This Week in Money.
Thanks a lot, Jim.
And you can find Ross's website at rossk.com. Thanks to our guests, Ross Clark, Marin Katusa, and Ross Kay, and thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.